Hi, welcome to STANLIB's weekly economic podcast. My name is Lings and I'm the chief economist within STANLIB. The intention with these weekly podcasts is to unpack some of the key economic developments that have unfolded over the past week. And for this week, I think we need to focus on the Reserve Bank's interest rate decision. They decided to hike rates 25 basis points, taking the repo rate up to 7%. And it might be worthwhile to discuss some of the rationale that the Reserve Bank put forward for that increase and what we might expect going forward. The other topic is we got the April government revenue and expenditure numbers, and while it's still very, very early in terms of the latest tax year, it is providing us with some insight as to how government revenue is holding up and what's happening to expenditure and where some of the risks might lie in terms of government's fiscal position as the year unfolds. So I think we focus on those two topics. There is some data out of the US that I think is useful, but I think we can pick up on that data next week when we can talk about the US labor market report. The main labor market report for the month of May is coming out on Friday, and it'd be useful to use that as a base to discuss the US's overall economic performance. So for this week, a focus on South Africa, and I think two key issues, interest rates and what's happening to government finances. So let's start with the US interest rate decision. In the end, the Reserve Bank hiked rates 25 basis points. That took the repo rate up to 7%. And if we think earlier this year, before the Iran conflict started, there was an expectation that the Reserve Bank would cut interest rates twice this year, each time 25 basis points. So a significant change in recent months regarding South African interest rates. The decision by the Reserve Bank was not unanimous. They've got 6 members on their MPC committee that makes the decision. 4 of those members opted for 25 basis points. The other 2 argued that interest rates should remain unchanged. So not a unanimous decision, although the Reserve Bank did admit that they discussed hiking interest rates 50 basis points. In fact, they said they discussed that extensively. And I think the reason would be that if you were to increase interest rates by 50 basis points, then you would be sending a very stark message that you are determined to get inflation back under control, and it would be seen as the monetary policy trying to get ahead of the curve. In the end, that decision wasn't made, 25 basis points. And if we look at some of the discussion points around that, there are a couple of things that come out that is very clear. First, the Reserve Bank is obviously worried about the higher oil price feeding into other price pressures, so-called second-round effects. And from their perspective, they say they see evidence of those second-round effects developing. And clearly, if those second-round effects develop more, then the Reserve Bank will be willing to hike interest rates further. So we can't look at this as a once-off increase and that's it. It's entirely feasible that the Reserve Bank will hike rates at least another once or twice this year if the conflict in Iran lasts longer, if the oil price remains elevated, and importantly, if there's evidence that the higher oil price is feeding into a broader range of price pressures, then I think we've got to assume that the Reserve Bank will be willing to take interest rates up a little bit further. The other thing that becomes clear is that the Reserve Bank is determined to achieve their 3% inflation goal. Obviously, a little while ago, inflation was at 3%. But it's now moved up to 4%, and it's very likely that in the next month or two it'll be closer to 5%. And obviously that's moving quite a bit away from the target. And so the Reserve Bank is sending a message that they are adamant in achieving their 3% inflation target and that they are willing to put the appropriate policy in place in order to achieve that. And they would argue that if you are worried about the growth dynamic of this country, then achieving a 3% inflation target is beneficial in the long term for economic growth. So there's no doubt that by hiking interest rates, you will do more damage in the short term to economic performance. Consumers will find themselves under additional pressure, but the Reserve Bank would argue that over time, getting inflation rate down to 3% matters more to the long-term economic well-being of the country than trying to gauge what pressure the consumers would be under for the next couple of months. So it's a very stark message, but it's a very clear message. that the Reserve Bank is determined to achieve their inflation objectives, and that they feel 3% is in line with what other emerging markets try to achieve, and that having a high inflation target is not helpful for South Africa. Obviously, the higher inflation rate together with the elevated interest rates does have implications for economic growth, and so the Reserve Bank revised down their growth rate. They were sitting at 1.4% for this year. They've taken that down to 1.2%. So a modest downward revision. Unfortunately, 1.2 is just hopelessly too little economic growth, and clearly South Africa is still struggling to gain significant growth momentum, and that's a whole different discussion and outside the realm of pure monetary policy. They've also revised down next year's growth. They were sitting at 1.9, they're now at 1.7, so a meaningful downward revision to growth, and at the same time a meaningful upward revision to their inflation expectation. They now think inflation will average 4.4% this year. They were previously at 3.7%, and for next year they think inflation averages 3.7%, which means the Reserve Bank only thinks that inflation gets down to the 3% average in 2028. And that gives you some idea of how much damage is currently being inflicted on our inflation dynamic. And that once inflation moves measurably away from the target, it takes a considerable effort to bring it back under control. And I think that's the overarching message that's coming through from the Reserve Bank's decision. In terms of some of the other dynamics they highlighted, I think it's important to recognize that most other central banks around the world have simply kept interest rates on hold, even though they themselves are experiencing upward pressure on inflation. So the Reserve Bank's move is definitely early in this current phase. It's not as if no central banks have hiked. A few have hiked, but the majority have left rates unchanged. That doesn't mean that those central banks will persist with their interest rate view. They are very likely to increase interest rates over the next month or two. And clearly the Reserve Bank feels the need to get ahead of the curve and make sure that they don't wait for second round effects of inflation to fully emerge before they decide to increase interest rates. So from the Reserve Bank's position, this would be in line with their stated objectives in terms of monetary discipline and in terms of ensuring that South Africa is on track to move inflation down to the 3% level over time. It will be applauded by the credit rating agencies because they would see it as consistent monetary policy and in line with what they would expect the central bank to do. So it will have a positive effect on credit rating views of South Africa, although no doubt in the short term it's going to put consumers under additional strain, and consumers are already under pressure because of the higher fuel price. The last thing just to mention is that we have seen the oil price come down a bit. I would say in the last 2 weeks it's come down by about 12-13%, so that's meaningful, and we've moved into an over-recovery position on the diesel price, which means that we can actually claw back the fuel levy, or half the fuel levy subsidy, and at the same time reduce the diesel price. So the diesel situation looks a little bit more favorable, and so we've got some leeway there. Not quite as good on the petrol. There is an over-recovery on the petrol price, but not enough to account for the fuel levy subsidy. So I think in June we're likely to see a reduction in the diesel price and an increase in the petrol price. But if things stay as they are internationally, then I think we're moving into a slightly better position in terms of our fuel inflation risk. And hopefully if there is a resolution to the Iran conflict, then we are likely to see the oil price move. Instead of being above $90, we would expect it to be closer to $80, and that would allow us to provide more relief in terms of the fuel price. So it's a slightly more encouraging story, although we still don't have a resolution to the Iran conflict. They keep talking about the possibility of a deal, but it just doesn't materialize. And so there is an ongoing significant risk. And there's no doubt the Reserve Bank will be willing to act against any of those risks should they materialize. So we can draw comfort from the fact that the Reserve Bank is at least consistent in its approach to monetary policy. It is to some extent predictable. In other words, the interest rate hike was expected by most analysts, but obviously anytime you increase interest rates, it does put the economy under pressure, and our economy is already fairly weak. So from that perspective, it's an unfortunate set of circumstances. The second topic is a quick discussion about government's revenue and expenditure for the month of April. It's the start of the new fiscal year, and so it's useful to have a look at where the numbers sit at this stage. Even though it's 1 month, it does give us an indication of where the trend is likely to develop, at least in the short term. So tax revenue ended up being ahead of budget, actually nicely ahead of budget for the month of April. And if I look at what caused it to outperform, it was really 3 areas. The first, income tax from individuals, that's held up very well. And I think that partly reflects some ongoing stability in the labor market, certainly the formal sector labor market. The second dynamic is decent revenue from corporates, and the expectation is that corporate revenue for the year as a whole should exceed budget, given that commodity prices were fairly elevated last year, and some of that will spill over into corporate tax revenue during the course of this year. And then the third element is VAT receipts, where consumer spending has held up quite well, and the government's been able to collect VAT ahead of budget. The area that was underperformance is understandable. The fuel levy underperformed by about 4 billion rand in the month. And I think that's understandable when you consider that the government had announced already the fuel levy subsidy, which was 3 Rand a litre for petrol and 3 Rand 93 a litre for diesel. And obviously that subsidy then results in the government collecting less revenue. That subsidy is going to be clawed back over 2 months, the month of June, and into July. And so the government is saying that they're not leaving that subsidy in place on a persistent basis. It's really just a short-term measure to help relieve the damage from the higher fuel price. And clearly, when they claw back that fuel levy, then you would expect that fuel taxes or fuel levy taxes increase and go back to what would be seen as more of a normal level. So the tax revenue holding up well. And it's expected that that will persist, mainly driven by corporate tax revenue. And so there isn't at this stage much anxiety about the budget that governments put through for their revenue collection. Where there is a little bit of anxiety is that government expenditure was ahead of budget, obviously very early on, but slightly ahead of budget. Where we have a bit of a concern is that there is a risk of more salary pressure emerging. If we look at Eskom granted salary increases of 7% a year for 3 years, inflation is moving up, and as I say, will get closer to 5% in the short term, and that may result in some additional spending pressure within government. And so we've got to watch to see whether that can be controlled. Obviously, a lot of people will look at government to see whether they can manage their own expenditure in line with the Reserve Bank's inflation target of 3%. So that's a bit of a test for National Treasury. That is the budgeted expectation that government will control their expenditure, but we've got to see whether or not that can be achieved, and there are a lot of moving parts, and clearly there's going to be quite a lot of strain on government expenditure. So we're off to a decent start in terms of the fiscal position, but I would say the bigger risk at this stage is some slippage on government expenditure as the year unfolds, particularly in a year in which we're going to have local government elections. And clearly that could put the fiscal position under strain by the time we get towards the end of the year. But importantly, I think tax revenue looks decent. It looks like it's holding up. And even though we're not able yet to accelerate South Africa's economic growth, we are generating a good tax revenue environment despite the weak economic performance. That's all from me for this week. Hope it makes some sense, and we'll catch up again next week. Please remember that STANLIB Asset Management is an authorised financial services provider in terms of the FAIS Act. Also, this podcast should not be construed as advice.